Follow the history topic today. So let's study the four worst falls in the market. So this is 1929, I suppose, uh, where the Great Depression happened. We can only try to see it on charts and try to visualize in our minds what would have happened back then. We're less than 100 years from that. Then the next really big sharp move was also on Black Monday of 1987, a single day, very sharp move of more than 20%. Then, of course, the dot com crash of 2008. Then, of course, the GFC, the global financial crisis in 2008. And then we had the COVID crisis also, which on a log chart, if you see the entire 150 years, COVID crisis actually is a blip, which is, hardly evident right here. Or is it this one? Yeah, it is this one. So I am not even able to pinpoint it on the chart because it is so small. So when we are living through a fall, it surrounds our mind in a way where we get encompassed with all the issues of the current fall, and we lose the focus of the larger picture. That always happens because you are in that moment, right? So your focus is exactly right there. What am I losing today? How much I've lost? Where was my portfolio 6 months back? So you tend to focus on your today, and you forget about the journey that you were on, and what gains you made in the last 10 years, and what gains you may make in the next 10 years. All that focus goes out of the mind because the volatility and the narrative around you and the noise and media is talking about it. Everybody's calling you, that stock market has crashed. I hope you're okay. All those kind of things happen during crashes, and that brings the focus to the today of the person. So that is the sort of trigger which causes you to take actions which may not be the right actions for your long term journey, which you had not thought you will do even if this came. I mean, if you were to look at this chart and say that, okay, if this were to happen, should I exit anything? Should I just continue doing this? But when you are living in that day, this chart will not be in your mind. The only thing that will be in your mind is that yesterday my portfolio was so much and today it is so much. So that's how the mind plays the games and deters us from this magnificent market returns that we are able to get. So let's look at 1929 crash. It is very important to see the context, what happened before the crash. So 1921 to 1929, the markets had a 25% CAGR. Can you believe that? 25% CAGR for 8 to 9 years running. And prior to that, the S&P 500 had plateaued for almost 2 decades. Imagine if you were coming into the workforce at a young age of 20, 25, and by the age of 45, you've never seen stock market gains virtually. So you would have absolutely no liking for the market, and the generation which was born and were in workforce in 1920s post World War One, they only saw gains happening for almost a decade, and hence they would not have ever thought that the markets can crash also. So 25% CAGR for 8 years running, and then the whole market came off. Lot of speculative excesses had built over that decade. Easy credit was available, rampant speculation was there. Investors bought stocks on margin and inflated prices unsustainably. Is this not sounding very familiar? I mean, if we were to superimpose where we are right now, I mean, all these line items would fit very nicely to today's market also. A wide gulf between the rich and the working class happening today also. Overproduction and weak demand happening today also. Industrial production grew, but wages lagged. Companies produced more than consumers could afford. Poor banking structure. Okay, so we have better banking structure, well capitalized banks. Policy errors. Fed tightened monetary policy in 2029 to control stock speculation, choking off liquidity. After the crash, authorities failed to provide stimulus, worsening the dollar. Global trade tensions, tariff raise import duties triggering retaliatory tariffs. We never learn from history. We are seeing that less than 100 years back, we crashed the markets, and tariffs were a situation where which did not go do well post that crash. But we want to try that again. So the crash happened from 1929, and it took nearly 3 years to wipe out 86% of the market. You can't even think of imagining this in nifty terms. It would be like going to 4,000 nifty from where we are. So just try to imagine, you know the kind of situation. But of course, we never had a 25% CAGR for the last 8 years, and Japan did that for a decade, and they also crashed heavily post that. So when you will have those kind of bubbles blow, the exits, the repercussion will also be severe. But then, if you were to see in the next 4 5 years, significant part of the damage was recovered. But then post that, of course, World War II, and your market just stagnated for the next 10 15 years. It is so easy to go on the chart over 10 15 years, but in real life, to go from one year to the other takes a lot of time. And eventually, in 25 years, the person who bought at the top of 1929, if he were alive and solvent, he saw his book come into profit without inflation adjustment. So that's the kind of crash that happened in 1929. Gold was also revalued during this period. So this is very important actually. That and this was the period of gold standard. So dollar was convertible to gold. Dollar $20.67 for every ounce of gold was a fixed price of gold. The gold was not varying like it is varying today. There was a fixed price of gold. Uh, Two things that they did post this was they banned private gold ownership, so they basically confiscated from citizens and revalued gold. So basically, because gold was sitting as a big asset in their balance sheet, they needed their asset to be revalued so that they could issue uh, more paper against that, more dollars against that. So 20.67 to $35, so 70%, in effect, devaluation happened of the dollar just by one stroke of the pen. And post that, of course, it was held at $35 going forward till 1971. I think in the books, they still have somewhere near $42, and they could revalue that gold in US balance sheet about 8,000 tons, and it will immediately get them about 7 or 800 billion dollars excess assets revalued in their books. Anyhow, so coming back to this, because the currency was not a fiat currency, uh, not linked to gold, they could not inflate the economy like they can do today. So they did try to revalue gold and devalue the dollar. Interest rates were high in that period, nearly 6%. And then they had to cut rates. They went down to 1 or 2% to prevent economic collapse. This also, I think, is the expectation now that as markets are coming off, interest rates should come off in the US. And they stayed low post that till World War II to support recovery and war spending and so on and so forth. So that was on interest rates. And crude oil during this period was also crashing. So crude oil crashed in that decade from nearly $3 to like less than $1. And uh, and then post that, of course, once the war etc started, the crude oil, so crude oil has been very very stable in history in terms of its price. But now, of course, with uh, no gold backing of the dollar, it can vary a lot. Black Monday 1987 crash was the second biggest crash of the markets, and we are referring to the US markets here because that's where the most of the data is available. So before the crisis, you can see that there was a huge bull rally from 1982 to 1987, and 5 years of 25% CAGR. So market went from three times in that period. And use of automated trading strategies led to cascade of selling, and aren't we seeing a lot of that also today? So market started to fall, amplified the decline, and Basically it was the post Plaza Accord. If you will go back in history, you will see that in the late second half of 80s, the Plaza Accord was executed, where other countries agreed that the US dollar will be devalued and other currencies will go up, so that trade is more easily able to do. And Trump wants to do that, but in today's context, because other countries are not allies of the US, or they are not so friendly with the US, they will not allow it to happen. So now it is a war of who's going to devalue their currency more. In those days, it was not such. It was not such. Uh, Here again, you can see this is a weekly chart. Most of the damage was done within 3 weeks, and 36% of basically the fall happened over 2 months. So it was just very sudden, 3 weeks, and then of course it recovered not so badly actually. In within 2 years, it recovered fully the crash that happened. So if you had 5 years of 25% CAGR and then 2 years of nothing, that is still not bad. If you were to redo the CAGR, it will probably go to 21% or 20%. So you have to see where the crash is happening versus the context. In our case today, if we go last 5 years, most strategies would do 20-25% CAGR, decent strategies anywhere. And now we've lost some ground there. So from that context, you have to see that it's not so bad. Gold during this period, of course, did not do well. So this was one aberration that happened here, because gold had gone from 1971, the Nixon window, till 1982, almost 20 times. And during this 80s period, Bank of England, China, Canada, etc., were just selling their gold all the time. They had a full program that every year we will sell this much. So gold went into a long bear market during this phase. Interest rates were in a falling phase since 1981, and they kept falling till very recently. The Fed, of course, paused hikes and eased policy, trying to stabilize the economy. That's exactly what they're trying to do now as well. The US 10-year yield, it rose very sharply during the Black Monday crash. Uh, it was basically reverse of what one would think would have happened. Like if you were to see the crash, it happened in towards the second half of July, or September, October actually. And here you can see that in October the yields collapsed right here. So this was probably the period of that collapse. Before that, the yields were rising very, very hard. Crude oil in this period was flattish. There was not much change during this. There was a small spike down, but not any major change there. Dot com bubble. Now, this, of course, happened much later. And the context here again was that for the last 25 years, you had a very nice 14% CAGR going. This was the 87 crash. So even from here, you can see, index went from 200 to almost 1400 in a matter of a decade or so. So tech companies were exuberant in valuations, zero earnings, valued in billions. We are seeing the same, or we were seeing the same, at least with a lot of companies here. Hype outpaced fundamentals, speculative IPO boom. We've seen that also. So nothing is changing really. What has happened in the past is happening every time. Easy money, Fed policy in late 90s fueled the tech frenzy. We had very easy money till few years back, where the Fed rates were sub 1%. Retail rush, first time investors piled in. Nothing new here as well. I mean, post COVID, we saw first time investors pile in, chasing momentum. Uh, Corporate misconduct, Enron, WorldCom's type scandals further eroded trust. There has not been any major scandals this time, which is the saving grace. But as markets continue to go off, who knows what may come out from that point of view. So 50% crash happened from March 2000 to October 02, about 2.5 years of a downfall, which was made up in the next 4 or 5 years to again fall in the next crash. So actually speaking, US investors, or investors in the US market, let me say, took a very long time to see a new high post the 2000 peak. Gold, of course, in this period started to go up, and 169% on this chart in this 7-8 year period. This was a flight to safe haven. So while S&P 500, the white line, did not do anything for about 8 years. Gold went up 169%. Interest rates during dot com crash. So once this markets crashed, interest rates had to come down dramatically in the next 2 3 years, and that was to try and fuel the recovery and the next credit-driven cycle, which was this, and then of course the GFC happened post that. So let's come to the fourth crisis. The fourth crisis was the GFC. Here again, you can see from 2002 to 2007, you had a very nice run of 5 years, almost 15% CAGR, which for the US market is beyond historical norm. The S&P long-term average is between 9% and 9.5%, I believe. So you had a very nice run for 5 years. And then, of course, the ultra low rates and loose lending led to price euphoria, housing bubble, and they created subprime loans, which which were very very risky, and they were trading as CDOs and MBS, and so on and so forth. So banks extremely overexposed, undercapitalized, regulatory failures, and of course then the Lehman crisis happened in September 2008, and the market complete confidence got lost. 50% crash in 1.5 years. So it was a slow crash to start with, and then once the Lehman crisis came through, then the bottom fell off the floor. It took about 5.5 years to recover from this crisis. In all, if you had bought in July 2007, you were out with some profit in 2013. So that was a long wait. Here again, gold did very well post crisis, and we are all talking about dollar terms here. So I mean nothing about Indian currency here. So in this period, S&P 500 was flat, of course, as it recovered. Gold went up nearly 150%, 140%, again proving a great hedge. Here, the interest rates were crashed down, learning from the past mistakes, and stayed low for most of the period of post that. And this created the seeds of the next bubble, so as to say. Crude oil in this period also collapsed. It went from nearly $150 to $44, and post that it recovered quite smartly. So we need to learn from history what has happened in the last 100 years. But we need to learn, but we never learn. Neither the investors, nor the banks, nor the regulators, nobody is learning from history virtually, and we are making the same mistakes again and again and again. Uh, the magnitude of the fall, the magnitude of the interest rate cuts, uh, only those things are changing a little bit, but other than that it is the same model. Every major crash is eventually giving way to a new bull market. So that is the sort of the silver lining you have to see, that in case we are in a crash which is of this magnitude, eventually a new bull market will come. So you need not feel despondent that you are living in a crash. As long as you will survive this crash, you will have fantastic opportunities going forward if history is again anything to learn from. Interest rates tend to fall during crisis, so easing liquidity and support of risk assets will happen. So as interest rates come off, hopefully markets will take off, emerging market flows will improve. Gold, of course, will continue to do well, I suppose, because there's a lot of geopolitical risk now, even more than ever, and uncertainty is just amazing. So now if interest rates come off sharply, gold is going to go through the roof. That would be the natural thought process on gold right now. Panic, of course, creates opportunities. So sharp declines leads to strong rebounds. Let's say in 2 days we come back to where we were last week. So it would have been a very very sharp down and up move. And if one were not able to take action for buying, that's okay. But the fact is that things have become faster and faster in terms of recoveries. um, there is so much more money supply in the world now, that any place where there is a crisis, money rushes to that space and boosts it up. Interest rates are at the verge of going down, I would think so. uh, Oil is at a very nice level for India, so India should benefit out of this oil crisis. Currency is something which is the, I think, the dark horse in the game, where Chinese yuan, and I wish I could have put up that chart. Chinese yuan is at that cusp of a major move. So the trump card that China could play is that they could devalue their currency, and if they devalue their currency to support their exports, uh, the Indian rupee, the USD INR will have to flow with Chinese currency, and that is the biggest risk I think for India from that perspective. Thank you so much for watching. Do subscribe to the channel if you haven't. And if you don't want to subscribe to the channel, please like this video and do share these videos with your friends and family. Thanks. Bye.